Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm back here today with Steve Farr and Todd Miller, also formerly of NCUA and also members of my team here at Credit Union Exam Solutions. How are you guys doing today?
Doing good. Happy spring.
Happy spring, we made it. For those listeners who may be new, Steve and Todd have been on many podcasts, and I'm going to have them do a little bit of an introduction of themselves, what they've been doing, what they did at NCUA, and then we'll jump into an exciting topic today. Steve, why don't you go first?
Yeah, I was just going to go through and decide to kind of update my career with the three parts. The first part was like 15 years as a problem case officer at NCUA, working with the problems mainly on the West Coast, involving consumer conservatorships, assisted mergers, and a lot of successful turnarounds. We turned credit unions around with zero capital back in those days. Then I went to the central office about the time Mark was in the central office and worked for the Office of Risk Management. And that was a fun career because I got involved in just a multitude of things that kept it interesting, involving the corporate turnaround. I would train examiners on problem resolution and wrote the enforcement manual and ended up with the risk-based capital and the vice president of the CLF. And then since when Mark started his firm up, we've gotten to be active back with credit unions again, looking at the problems. I did a stint as a CEO for a large conservatorship in Manhattan, New York, which was fun. But it's been a fun after 30 some years in NCUA to be able to take that experience and continue to apply it and keep sharpening our saw has been really nice.
That's right, sharpening the saw, the old Stephen Covey thing you taught me way back in the day. Very good. And Todd, how about yourself?
I was with NCUA for 34 years. It's interesting about the first 8 years of that. I was actually under the same supervisors as Steve, kind of working on the same kinds of things. And then my path diverged a little bit. He stayed a problem case officer a lot longer than I did. So I spent about 10 years or so as an examiner and a problem case officer. Then I spent a decade as a regional capital market specialist from 2000 to 2010. And from 2010 to my retirement in 2011, I was a director of special actions in the Western region, supervising those problem case officers and capital market specialists and regional lending specialists. And then I had the last year in there where you drug me into Westcor for all of 2009, and when you were the agent for the conservator for Westcor. And you let me retire for about 2 months before you called me and convinced me to come help you and help credit unions from the other side of it. And it's been enjoyable to actually take that 34 years of experience and help credit unions along the way.
Yeah, it has been fun. That was 2021 when we came through in our then Class B through Montana, spent some time with Steve, and then recruited Todd. And here we are in 2025. Time flies, guys. So this podcast is, I think, going to be some fun because we're going to talk about the 2024 trends that came out, the data that came out from NCUA, which is a lot of raw data. But before we jump into that, number one, we're going to talk about some general multi-year trends that kind of have got us here, right? Because if you lose track of history, you're condemned to repeat yourself. And then after we walk through the multi-year trends and the 2024 trends, we're going to talk about some of the things that we've been seeing in our clients, in our general conversations with credit unions, et cetera, excuse me, et cetera. So with that, let's start talking a little bit about the general multi-year trends as a primer for this discussion.
Steve's got his head down. I guess he wants me to chat.
Yeah, go ahead,
So,
Todd.
it's interesting. After that last recession, we had a long decade, really, of 2012 up until about 2020 of really flat rates. Not a lot was going on in the credit industry. And then COVID disrupted the whole world. And that is still having a huge impact on credit unions today. During COVID, that savings rate jumped up to the 20% range. Credit unions had these massive surges of deposits, and that was causing pressure on capital, and interest rates were low. So what did a lot of credit unions do? They went a long term with a lot of that COVID money. They bought long-term investments. They made real estate mortgages at 3 or 4%. Of course, then we hit inflation right after that. All of a sudden, people have less disposable income. Those deposits flow out the door. The Fed raises rates to fight the inflation, all of a sudden net interest margins are shrinking. Earnings in credit union industry have been declining since COVID, just about every year. And so a lot of decisions that credit unions made back in the years of COVID are still impacting their earnings today. The agency's been beating them up about interest rate risk and about credit risk because of decisions they made following COVID. And we're still seeing that now. During inflation, savings rate went down, credit unions had to compete for funds. So it's just somewhat interesting. Then with the inflation years, you had this surge in loan demand. So loans went way up. A lot of that is because people seeing their disposable income relative to inflation fall, and it hit the lower income people really hard. So you had this surge in credit card borrowing. You had surges in just about every kind of borrowing, to be honest with you, with no share growth. And now, as we get into 2023 and 2024, you're starting to see unemployment creep up and it's affecting credit quality. So now the agency is kind of focused on credit quality, and it's not anything that credit unions have done to change how they've made loans. It's just the general trends in the economy that, once again, inflation is still faster than wage growth, and we got unemployment growing up in, I think, 47 of the 50 states. Unemployment went up last year. So that's putting pressure on asset quality. So everything that's going on today is a result of decisions credit unions made in the last 2-3 years.
Well said. Steve, any thoughts you want to add to that summary?
No, that's a good summary, and it's really most reflected, and we'll cover it a little bit more in that creeping of the provision for loan losses. You went through 2001, 2002 as almost no loan losses, and now we're back above what would be the long-term normal that we've had for the industry, which used to be about 0.4, and now it's creeped up to 0.6, and that's been a real hindrance for the credit unions. So.
Yeah, you add the extra PLL and the inflation, which impacts their operating expense, that kind of figure out why that the net income is down. And one of the things, Todd, as you're walking through that, I've had some conversations, I've said it on some presentations I've made with some league groups, is that it's kind of like that triple black swan event. You had COVID, and then you had the Fed rate. People went long, started to go long because they thought, hey, this is the new normal, rates are low. And then the second black swan event was Fed rates going up 550 basis points. I think it was 550. And then inflation from all the money we were printing and other reasons. Those three black swan events have really led us to today, which get us to the stats that we're going to talk about next. So
yeah, and you had a new accounting standard in there for the loan losses. Let's
yeah,
just keep piling it on.
Yes, yeah, actually, I just got an email from a vendor that was trying to touch base with me when I was at CUNA, or America's Credit Union's GIC, about some CECL issues that have popped up for one of his clients. Anyway, I digress. All right, they lay out this data in one direction, but we thought we would walk through it in the state of affairs of Camel, because we talk about Camel a lot. Any thoughts on what the report is showing as it relates to capital?
I just noticed that we did have an increase in the net worth ratio for 2024, and that's really that's good. Much of it is because we did have, of course, the growth rate and net worth did exceed the growth rate and for shares, not by a lot, but by enough to make a difference. And it was kind of interesting. I've been tracking a lot of growth is from share growth. And so I tracked, you had more in dividends that were going into the shares. So what was the share growth rate with discounting dividends? And it was about half of what is reported as the growth rate if you take out dividends from there, around 2.16%. And that compares to how big 2021 was from that norma, which was 12%, excluding dividends. But dividends are going in and contributing to share growth. The other thing, though, that we've looked at a lot is the gap equity ratio, because there's some always items that are non-GAAP in the net worth ratio, but that showed improvement quite remarkably from 9.11 to 9.66. And that is the result of the unrealized loss in the investments has come down pretty substantially. So that is my nutshell on capital. Todd?
I would just point out the gap net worth that Steve mentioned. 2024 is the first time that ratio has improved since 2020. And part of that is, as Steve mentioned, the growth has slowed way down, so credit unions have been able to actually accrete a little bit of capital. I do think credit unions, NCUA puts it on the FPR. It's not on their key ratios with their exams, but credit unions should probably pay attention to their own GAAP net worth because creditors look at that net worth when they're underwriting loans and things of that nature. So it is an important number, even though NCUA de-emphasizes it for the most part.
And I'll
Yeah,
just add, go ahead, Steve.
yeah, as a measuring stick, I compare credit union performance a lot to what I can see in the community bank environment. And their leverage ratio is 10.82 and our net worth ratio is 11.21. So real comparable.
Yeah, that's good. That's good data. I recently listened to Treasury Secretary Scott Bessent on the Odd Lots podcast, which is a Bloomberg podcast, which is really educational. But the Trump administration, the Treasury Department head, is one of their goals is to get 10-year Treasury rates lower. Easier said than done. And then, of course, there's the Fed that makes the decisions on rates, et cetera, et cetera. But if that goal is achieved longer term, I think that gap equity will recover more. Any thoughts on that?
It kind of depends on the shape of the yield curve a little bit. If the 10 years come down, it will definitely help the investment portfolios. There's still a lot of investment. You can see that the maturity of investment portfolios are still lengthening, even though they're shrinking. And as the investment growth is negative. Credit unions are putting that into their loan portfolio, but they still have this overhang of long-term investments that they bought in 2022 and 2021. And it's still going to be with us for a while yet. Still a lot of investments are over 3 years on their balance sheets. And a lot of those are mortgage-backed securities that are paying 2-3% coupons. Those people are not refinancing.
Yeah, I was just chatting with my daughter about the good fortune of having a 26 years left on her fixed rate mortgage. So great point. Great point. All right, let's pivot to asset quality. I know one of you or both of you in a lot of our conversations talks about how it's when asset quality fails, it's what kills credit unions oftentimes. So I hope I didn't steal your thunder there, but let's fire away on asset quality.
Todd, go ahead. I think you have lots of data on this one.
I do have lots of stuff printed out on this one. It's nice NCUA's call report now. It breaks delinquency and charge-offs down by those individual loan categories. So it takes you a while to sort through it to find it all, but it is all there. This one kind of follows really much the COVID pattern too. During the COVID years, loan growth was pretty small, down at 4%, 7% in 2021. Then as we came out of COVID and inflation hit, loan growth hit 20%. When it fell to 6 last year in 2024, it was only 2%. So it slowed way down. But you just look at delinquency, and delinquency has been creeping up in virtually every loan category on the credit union's balance sheet. Credit cards and been hit really hard, unsecured hit really hard. You're seeing it in the new car loans too. I mentioned people, especially the lower income, they started borrowing more during that high inflation period. You really see that in credit card charge-offs, which, over the last years, it went from 2% to 3.8% to in 2024, 5%. And we see some of our large ones type clients, the credit card charge-offs, whack some of their capital plans pretty hard because of that experience. But even new car loans, just in the last 2 years, have tripled their delinquency level. Used car loans have tripled in charge-off levels. All the car loans are up to about 0.84 charge-offs. That's a pretty big charge-off number. It was only 58 basis points in 2023. So it's a pretty substantial jump in that consumer loan. We do see a lot of credit unions making first mortgages and going back to home equity loans. Charge-offs with real estate loans have actually held up pretty well. They're staying fairly small, down at less than a couple basis points is all. So no one's charging off real estate loans at the moment, residential real estate loans. And commercial loans, which they haven't had the yo-yo growth. They've been growing pretty steadily at a moderate pace through all of this. And their delinquencies have creeped up a little bit, especially with some of the commercial and industrial. That actually improved in 2024. It kind of peaked in 2023. but commercial loan charge-offs have been at 20 basis points is all. So that's almost one of the best performing pieces of the loan portfolios and credit unions out there. Residential real estate loans are doing the best credit quality wise. Commercial loans are doing the second best. Consumer loans are getting hit pretty hard in the
And so,
last
Todd, if you had
year
to
and a half.
venture a reason why the consumer portfolio has experienced this higher delinquency and losses.
Because unemployment has went up in 47 states for 2 years in a row. Credit unions can't really control the job market and they fall victim to those trends. And it's somewhat why some of that multi-portfolio and multi-dimension analysis is important to pay attention to what's going on with their portfolio. And it probably explains why your commercial loan losses are less, is because you're doing annual reviews and talking to them, and you can deal with problems and head them off early with your commercial borrowers. Where with the consumer loans, a lot of it's indirect lending. You maybe never talk to the member until it's a delinquent. And if the person's lost their job and they're delinquent, there's not a lot they can really do to help that member out. So that's kind of why you make sure you price things appropriately so you have some sufficient spread to cover those provision for loan losses. And like I said, with when charge-offs are going up every year, that provision is going up every year. And Steve mentioned that earlier in our podcast, that whole growth in provision for loan loss expenses.
It's turning out to be a pretty big competitive disadvantage compared to the community banks because they're experiencing higher delinquency, certainly consistent with our numbers, but their PLL expenses is 0.15 and ours is 0.60. So that is the difference between the actual net income realized by credit union industry and the community banks. It's just that increased losses. And certainly, Todd, if inflation stays lower, that should be really helpful, as I think that hurt a lot of people in the last primarily year or so.
Especially people at the lower income. I don't remember what the article was last year in the Wall Street Journal. It was a huge percentage of people can't cover a $400 expense out of cash. And when you get that inflation level like that, it hits those low income people pretty hard. And we have quite a few of low income and minority development institutions out there. The credit union industry does have a certain segment of credit unions that serve that low income audience. And I would suspect almost every credit union out there has a percentage of their members sit in that lower income stratosphere. And, that inflation hits them hard. And when they get to unemployment, it takes them a couple of weeks to get checks. They only get unemployment for 26 weeks. That job market is tough. So that people in that, I don't know, bottom 20%, bottom 30% of the economic pile, it's really tough on them when they're facing inflation and unemployment is going up in, like I said, 47 states.
Yeah, one of the things I heard that put that in good context for me was if you have assets and there's inflation and you're in the stock market and the stock market's going up, you're not hit by the inflation as much, and you also have a little bit less pressure on your income. So your stock funds are going up, you own real estate, that's going up. If you're on the other end where you're struggling paycheck to paycheck and can't pay a $400 bill, and then that $400 bill 18 months later isn't a $400 bill, it's a $600 bill, and you happen to lose your job, the barbells of the haves and the have-nots have gotten more pronounced over these last several years, and it's not a good thing, and it's going to have continual issues that trickle into society. And as we're talking about it, we're seeing that it's trickled onto the balance sheets.
I think this gets distorted a little bit too by COVID. There was so much government assistance piled out to people at the lower income levels. It improved their credit scores. So it actually made them more able to borrow money when the inflation started. So you had a temporary, you're almost hiding some of your higher risk people with all the government assistance that came out during COVID. So that's impacting this a little bit as well and leading to some of these higher charge-offs. I'm sure that's especially the case with the credit card portfolios that improved credit scores. It got these people a lot of new credit cards and they used them. And now you got charge-offs at 2.1% on credit cards in 2024. That's a pretty big charge-off number for credit unions.
said. Any final thoughts on asset quality, guys?
No, other than you're going to continue to see it's on NCUA supervisory priorities, and this is the reason the delinquency and charge-offs have been creeping up in just about every loan category. And credit unions, it's to your advantage to understand what's causing your charge-offs. Is it unemployment? Is it something else in your underwriting? So larger credit unions make sure you're doing that analysis of your charge-offs and figuring out, okay, what is the cause of this? And the second piece of it, it just comes back to you need to price for some of this because it's likely to remain elevated for a while.
Good point. Good point. So the stats don't talk about the M in camels, so we'll jump over that over to earnings.
Yeah, when we talk to earnings, I'd like to get Todd's opinion because he's so well versed in the ALM thing and talk to the issues affecting the net margin.
It's somewhat interesting, Steve, that if you look at NCUA, when they put out quarterly data, they put out a chart pack that's got 42 tables in there, and about half of them are boring, but half of them are actually very useful. One of them they have in there is ROA components, and they track it from 2015 to now. And we talk about the net interest margin, and it was fairly up to 3.2 in 2019. It fell to 2.6 during COVID. So it got really small, but it's actually improving back to 3.1. So it's back to where it historically was. It took credit unions 2023 and 2024 to adjust. A lot of them got beat up by their examiners, but that net interest margin has adjusted. What's really impacted credit unions is pretty much you've seen a decline in fee income that started in 2018 and continues to today. And I think part of that is the rising rates. You're making less real estate loans. And I think some credit unions are very sensitive to Biden's whole era of junk fees and things of that nature. But fee income has come down. And then you talked about it right at the beginning of the podcast, that provision for loan loss expense. It was 30 basis points back pre-COVID or back in 2015. It hit during the middle of COVID in 2021. You had 10 basis points of provision for loan loss expense. And in 2024, it's 62 basis points. So you've had 50 basis points increase in PLL expense just in 3 years. So credit unions seem to have recovered on that interest margin a little bit. They've made adjustments, but they're still fighting that PLL expense, and that fee income seems to have stabilized the last 2 years, but it certainly is down from what it was 4 or 5 years ago. And until rates fall and you start seeing real estate origination fees go up, I don't think you're going to see much increase in fee income across the industry. There's just a lot of political pressures against it. Maybe with a new president that will subside for a bit, but the consumer groups complaining about all the fees attached to overdrafts and things like that, I don't think that's going to go away. It might simmer in the background for a while, but it's going to come back to the forefront at some point in time. It's not going to go away entirely, I don't think.
That pendulum will swing. Anything that the data shows you on operating expenses other than the PLL that jumps out at you?
Yeah, when I was an examiner, I was always focused on that was an area that we could make a difference and see it in the short run was adjustments and what we could do in the operating expense level. And for the year, net non-interest expense was up 6.2%. The categories up the most, of course, employee compensation, which is about 7%. Office operations at 6.5%, and professional and outside was up 7%, Mark. So you must be getting a lot of clients in there that are bringing that ratio up and hurting the cause. But and compared to what happened with community banks, their expenses, the same ratio went up 5.4%. So a little bit of difference there. But the other thing is when I pulled the income statement for the industry was all of the activity and the gains on derivatives, this disposition of assets, sale of loans and sale of other real estate owned, gain from bargain purchase, merger, and other interesting. All those show a lot more activity. And the other income figure of 14 billion is basically equal to the net income for the industry. And that's the same for the last 2 years. A little interesting kind of change in the numbers from what we've seen more historically.
And that other of those other, that reminds me of some things we've heard in credit union conversations. What's your core earnings? So that old Suzanne Vega line, it's a one-time thing. It just happens a lot. This year you sell your Visa stock. The next year you have some other oddball item that helps you show a profit, and then NCUA comes in and focuses on core. Todd,
Yeah.
any thoughts on what Steve had to say there?
I was going to mention the number of credit unions that had negative earnings last year, but I don't have that spreadsheet open and I didn't write it down in my notes. And I didn't have time to actually go back and compare it from other years. But there are a not insignificant number of credit unions that are experiencing negative earnings at this point in time.
Yeah, that's always an interesting way to look at it too, is there's the winners and the losers on the net income in particular. And it's always a number when you look at it, it's bigger than you'd think. Every time you look at it, it's a good reminder that there's a lot of credit unions that are struggling. And then that has them, what does that do to their capital? What does it do to their camel code? What does it do to how frequently NCUA shows up and asks them about all those things? And I think, in my opinion, I think the pressure on merger will still be there. But not even having that number in front of us, knowing it's not a small number, I think there'll be pressures on mergers and such. Any thoughts on that?
I do have the numbers on merger though. That's in the 10-year trends. It's in the back of the recently released annual report, and that we had 138 mergers, 2 assisted, and that's down from other recent years, slightly down. But then, yeah, and then you get down to the number. We can talk a little bit about the number of troubled institution, and from that same report, 135 that are troubled credit unions. 16.6, the shares in millions is 16,000 in millions, so billion there, and that's a substantial increase. And that we have many larger, more, or an increase in the larger institutions that are troubled.
And for the listener, definition of troubled?
Camel 4 and 5.
Yep.
And we'll talk about Camel 3s. I just want to point out another thing. During COVID, we were losing about 30 credit unions a quarter. I have Steve's data quarterly. Here in 2024, the quarters went 44, 34, 39, 32. So it's up a little bit. Actually, in 2022, a couple of years after COVID, that's when the mergers were really high. They were running about 50 a quarter.
Yeah, there was some pent up demand there. Yeah, and of course the number, they only charter 1 or 2 a year. The percentage is a touch higher than when you just look at the gross numbers.
Well, surprisingly, I have the percentage change in credit unions. It's been 1% every year downward.
There you go.
So we have less credit unions. 60 a quarter is turned into 40 a quarter, but we went from 6,000 to 4,000. So we're basically losing 1% of our credit unions every year. NCUA's chart pack that they put out, it goes back to 2015 by quarters. It's been 1% every quarter. I remember it was like 10,800 or something when I started in 87. But that number that we lose every year just seems to be fairly constant.
Yeah, good
same
point.
with the community banks. If you look at the number of them, they disappear at about the same rate.
Yeah, unless two things that could impact that, speed that up, would be mergers of the agencies or loss of the tax exemption, which I've talked about on other podcasts, most notably one with former NCUA PACA director and former CUNA guru, John McKechnie. If you're interested in those topics, check out that podcast. All right, so let's see. I think we're at L. I got a feeling that we want to hear from Todd on L, because all that capital markets knowledge.
I would just say overall, what you're seeing in 2024, cash positions are improving. Credit unions are relying a lot less on borrowed money and non-member deposits. So part of this is loan demand is way down. So they're actually able to improve their liquidity position. Short-term investments are still pretty low at 4.4 of assets. Long-term investments over 3 years, they're still 10% of assets. That's that hangover from 2022 still. But overall, in general, liquidity levels are improving throughout the industry.
Good news. Good news. And anything on, when I was back at still a regional director, it was Camel instead of Camels. I still call it Camel because old habits die hard. Anything on sensitivity that you'd like to add to the mix?
Just a couple things. That long-term assets are shrinking. That's an indication that interest rate risk is improving. The NCUA has beat people up over shares migrating from non-maturity shares into CDs and money markets and things of that nature. I will just say that there's going to be a little bit of that continuing. I have a chart. The share structure now is still less hot money than it was before the last recession in 2007. So we're reverting back to a mean. Rate sensitive people are moving to rate sensitive accounts. That's going to continue a little bit, although we're nearing the end of it. We talked about it already. Net interest margins, they're back to 2019 levels. So hopefully there will be less pressure on credit unions to de-risk in terms of interest rate risk, because it's improving slowly too.
Which is good news. As we wrap up those, we're going to talk a little bit about what we've been seeing with our clients. Looking at the watch, I know that. Go ahead.
I want to say one sentence on camels.
Okay.
They have a chart, an NCUA's chart back for that too. In general, camel rations are improving with one exception. Code threes and those 500 million to 1 billion and 1 billion to 10 billion and over 10 billion are really been increasing the last 3 years. Under 500 million, camel codes are getting better. That over 500 million, the number of code threes has been growing for basically 3 years in a row here. I think it's just interesting because usually those larger ones tend to perform better, and that's not the case recently.
If I was a cynic, I would say in good times, the bigger ones get treated a little kinder on camel, maybe appropriately. And when the economy gets a little bit more rocky and there are real or more material issues to raise with the big ones, NCUA gets a little bit more aggressive, and that's what we're seeing. A little bit more maybe truth in colding in the big ones when there's really actually something to talk about. And the smaller ones tend to get beat up about operational type issues just because of their resources sometimes. So their camel codes, in my opinion, are a little bit more reflective of that. And I know that we're gonna wrap this call up in about 8 minutes because some of us on this call have to talk about some of the issues we just talked about with the client that's dealing with NCUA coming up very soon. With that, let's talk a little bit about the things that we had one podcast which was one of our very popular ones. They're all relatively popular, but that one was particularly popular in the respect of talking about the things we've been seeing in our discussions with credit unions, clients, and other conversations. Let's hit those and use the rest of our time here on that.
I think, the biggest concerns that we talked about here, the negative trends, are all having to do with asset quality. So we spent a couple years where our clients were getting beat up about liquidity and interest rate risks. There's still a little bit of that going on, but their supervisory priority is on asset quality, and we are seeing a lot of that in our clients. Commercial lending programs, even if there's zero losses, they're still getting criticized, especially on their risk rating and the annual reviews. There's a higher expectation of board reporting with commercial lending. And we hadn't seen this for a few years, but in just the last 6 months, this has come up in 2 or 3 credit unions. NCUA is focusing on charge-off policies. They want loans charged off if they're not performing. And so there's always been an emphasis on concentration limits, and NCUA is asking credit unions to justify them. But what we've seen in the last 6 months, they seem to be getting increasingly granular about the concentration limits. They're getting doors. It's like, we don't want a concentration on indirect lending. We want one on indirect lending. We want a concentration limit on high LTVs. We want a concentration on credit scores less than 640, things of that nature. And along with, we mentioned this, with the losses, appropriate pricing, we're seeing our clients get doors and findings on proving that your loan programs are profitable. And that one's at a very granular level too over time. They want it broken down into more finite and discrete portions of the loan portfolio. So that's a big one that's new in the last, 6 to 9 months that we're seeing. Good point.
Steve, any thoughts on those items that Todd?
No, I covered those. One item that we were seeing as a really big focus that was coming out of course, FDIC, that was the corporate governance issue. And while the kind of a proposed rule that was put out on there is very good guidance, that was withdrawn with the change in the administration. And so I think the examiner comments on corporate governance won't be as strong, but me personally, I still feel that area is one when you strengthen that, you really strengthen your institution.
And
And
And you said it on the front end, but I'll repeat it. That was FDIC guidance. We've talked a lot about it here. We did podcast on the FDIC guidance on corporate governance in 2024 and 2023 conversations with credit unions. We were seeing NCUA getting hit hard on that. And any topic that was brought up, they seem to link it back to corporate governance. They seem to, on some of these issues we're seeing, they've seemed to, maybe that's just not on their checklist of pushing it this year because they seem to have backed off a little bit on that. I'll also say on the commercial loan topics, we have a lot of good podcasts on that. If you have commercial loans and you're getting beat up on that, feel free to reach out to us and or check out those podcasts, which are with Vin Veeten of our team, who helped write and was the major author of the current commercial loan rule.
yeah, one thing that I've noticed that we were hearing a lot about is a lot of our clients are saying that they're getting a lot of different examiners in, even though they're experts. So they're having to kind of work with the examiners and getting them familiar with their institutions. And that's something I think that might be an ongoing issue as we look into this year, and that it's probably just something that's going to have to deal with.
You got it. Good points.
And there
Todd,
is some continuing things in the last 3 minutes.
Yeah.
While liquidity has been beat up on a lot over the last couple of years, it's less, but we're still seeing a lot of credit unions get criticism on their liquidity contingency funding plans. Not so much general liquidity, but the contingency funding plan. The early warning triggers seem to be a big thing that they're focusing on, and having sufficient sources of liquidity for contingency funding purposes. Those still are recurring items. It's more defined than liquidity in general, but the contingency funding plans are still getting a high degree of emphasis from examiners, especially the early warning indicators.
Very good. And then enterprise risk management's been getting hit in the larger credit unions in particular, and eventually that will bleed. And I think also one of the things we've been seeing is the profitability issues that we've discussed here, and the trends is something that we're starting to see brought up as well. Any final thoughts on recent exam issues, guys?
Have issues with your examiners, give Mark a call. We'll help you
That's
out.
right. Yeah. Call Ghostbusters or call us, one of the two. Very good, guys. As always, this is a lot of fun. And I will say one more time, the recent exam issues that I mentioned, most of those we have separate podcasts on. So whether it's commercial, concentration loans, interest rate risk, liquidity, contingency funding, enterprise risk management, we hit all of those in separate podcasts that you can find just by Googling or sending me an email, and I'll send you a list of the ones that you want me to track down for you. All right, guys, always enjoy this. Thanks so much for your time.
Bye.
Listeners, I want to thank you for listening. As always, hope you will listen again soon. This is Mark Treichel signing off with flying colors.